If you want to lower your lifetime tax bill, you're in the right place. Welcome to Rooney & Associates TNT Tax Strategies, where we believe in paying Uncle Sam what you owe, but never leaving a tip. The 2 out of 5 year rule, formerly known as IRS Section 121, allows homeowners to exclude a significant amount of capital gains when selling their primary residence, if certain criteria is met. It can significantly increase the amount of money you get to keep from the sale of your home by reducing or eliminating your tax burden. To qualify, you must have owned the home and have used it as your main residence for at least 2 years out of the last 5-year period ending on the date of sale. Single filers can exclude up to $250,000 of gains, and married couples filing jointly can exclude up to $500,000 of gains. By providing this tax break, the government encourages homeownership and helps people build wealth through real estate without being heavily taxed on the appreciation of their home's value. Those with an interest in real estate can leverage the 2 out of 5 year rule to employ various strategies. The most common way we've seen this is retirement downsizing. This is simply utilizing the exclusion when moving to a more manageable house after kids have launched. This strategy can free up substantial tax-free cash for living expenses without increasing taxable income. Another strategy is living in a house for 2+ years while fixing it up and then selling it for a gain while receiving the capital gain deduction. And finally, you can turn an existing rental property into your primary residence for over 2 years, eliminating or totally reducing capital gains upon a subsequent sale. It's important to note depreciation claimed during rental periods will still be taxed or recaptured. So how can using this rule reduce lifetime taxes? Let's look at an example. Say we have a couple named Tom and Carol. They purchased their home 7 years ago for $600,000. During their time in the house, they put in a new front porch, bathroom, and upgraded their kitchen, all for $100,000 of capital improvements. Then they sell the house for $1 million. To see the impact of the 2 out of 5 year rule, let's calculate the tax impact with and without the exclusion. First, calculate the cost basis, which is the original purchase price plus any qualified capital improvements you've made to the property. For Tom and Carol, the purchase price of the house was $600,000. They made capital improvements of $100,000, so the total cost basis is $700,000. Next, look at the capital gain, which is the profit from the sale, or the selling price of $1 million, minus the cost basis of $700,000. So the total capital gain for Tom and Carol is $300,000. If they had to pay tax on that capital gain, it would have been $45,000, assuming their capital gains rate's 15%. However, there's good news for Tom and Carol. They get to apply the exclusion amount of $500,000 against their capital gain of $300,000, so they can deduct the entire gain. In this scenario, because the gain is fully offset by the exclusion, the couple would owe no tax on the profit from the sale of their home. If you want more tips on lowering your lifetime tax bill, be sure to check out our website at raawealth.com. I'm a CPA and certified financial planner. My name is Tyler Peterson.